Every time you swipe your credit card, every time rent goes up, every time the price of groceries increases, you're actually feeling the impact of one institution, the Federal Reserve. But how can one organization control the world's largest economy? Let's break it down in the simplest way. The Federal Reserve, or the Fed, is basically the central bank of the United States. Think of it as the guardian of the American economy. It has two big responsibilities: keep prices stable and make sure people have jobs. But balancing these two goals is extremely difficult. If the Fed tries too hard to stop inflation, jobs can be lost. If the Fed focuses too much on increasing jobs, inflation rises. That's why Fed decisions are so powerful and so important. The Fed's biggest tool is something called the federal funds rate. This is the interest rate banks charge each other for short-term loans. But even though it sounds like something only banks care about, this number affects your entire financial life. It determines how expensive your credit card becomes, how much you pay for a home mortgage, your car loan, your student loan, and even how much interest you earn on savings. When the Fed changes this rate, the whole economy shifts. When prices are rising too fast and inflation becomes a problem, the economy overheats. People spend too much, companies can't keep up, and costs go out of control. To cool things down, the Fed raises interest rates. When rates go up, borrowing becomes more expensive. People spend less because credit cards, mortgages, and loans all cost more. Businesses slow down because expansion becomes costly. As spending decreases, prices stop rising as fast. In short, the Fed raises rates to cool off the economy and bring inflation down. Now imagine the opposite. Businesses are laying off workers, people are saving too much, and the economy is slowing down. In this situation, the Fed lowers interest rates. When rates fall, borrowing becomes cheaper. People buy more homes, cars, and goods. Businesses expand because loans are affordable again, and that leads to more hiring. More jobs lead to more spending, and the cycle becomes positive. The Fed cuts rates when it wants the economy to grow faster and unemployment to drop. But the tricky part is that the Fed can't make everyone happy. If it fights inflation aggressively, people lose jobs. If it fights unemployment aggressively, inflation rises. It's a constant balancing act. For example, during 2022 to 2024, the U.S. faced high inflation, so the Fed raised rates aggressively. This slowed down the housing market, increased credit card debt, and caused some layoffs. But it was necessary to stop prices from rising uncontrollably. The Fed's decisions affect your daily life more than most people realize. When mortgage rates were around 3%, a $400,000 house cost roughly $1,700 per month. When rates hit 7%, that same home cost around $2,900 a month, an extra $1,200 every single month just because rates went up. Credit card interest increased from around 16% to over 24%, meaning a $5,000 balance suddenly cost almost double in interest. And when borrowing becomes expensive, companies stop expanding, which often leads to layoffs. Most Americans never see the Federal Reserve, but they feel its decisions every single day. Your rent, your loans, your savings, your job, the price of groceries, everything is influenced by the Fed's interest rate decisions. So here's the entire U.S. economy summarized in one line. When the Fed raises interest rates, it's trying to slow inflation. When it cuts interest rates, it's trying to boost economic growth and increase jobs. That's how one institution controls the financial heartbeat of 330 million people.